Hello, my name is Tej van Pettinger from Economics Help, and today we're going to describe about exchange rates. Exchange rates reflect the value of one currency against another. So, for example, with one British pound, you can get about $1.5. And over time, these exchange rates can change. So, for example, about 30 years ago, one US dollar was worth about 20 Russian rubles. But in the past 20-25 years, the ruble has fallen in value, and so now you need 100 rubles to get one US dollar. So what does this mean if the ruble devalues, depreciates in value? Well, for an American, it means that it will be cheaper to buy Russian goods, because whereas $1 used to only get 20 rubles worth of goods, now you can get 100 rubles. But for a Russian trying to import, it will be a lot more expensive because you need a lot more rubles to get that good worth, say, $1 in America. What can influence the value of the exchange rate? Well, the value of the exchange rate is determined by supply and demand. Supposing that there is an increase in demand for going on holiday to Britain from American tourists. So if American tourists come to the UK, then they will buy British pounds and sell dollars. So when they buy British pounds to be able to come and go on holiday here, the demand for the pound will go up. So demand shifts to the right, and so now the pound is worth more. You get $1.7 rather than 1.5. This increase in the value of the pound is generally good news for British consumers, because if they're wanting to get American goods, it's effectively cheaper because they need less pounds to get the same goods as previously. But for an American coming to the UK, they'll find prices a little bit more expensive because you need more dollars to get British goods. Now, apart from supply and demand, what are the general factors that determine exchange rates? Well, the big factors that influence exchange rates are things such as interest rates, inflation, state of the economy, and general competitiveness. So, if there's an increase in UK interest rates, why does that affect the exchange rate? Well, what it means is that you'll get a better rate of return saving in a British bank. So if you get, say, 5% interest in the UK and 0% in Europe, then investors with a lot of money will tend to shift their money into UK banks to get that better rate of return. So higher interest rates tend to cause a rise in the value of the exchange rate, especially in the short term. Whereas if you cut interest rates, it's less attractive to save money, and this may reduce the value of the exchange rate. In the long term, a very important factor is relative inflation rates, relative competitiveness. So, for example, suppose you have a country like Japan, which has very good productivity and low inflation over a long period of time because they're introducing new technology, becoming more productive. What will happen is that Japanese goods become relatively more attractive. So if you have, say, inflation of, say, 5% in the UK, but just 1% in Japan, then British goods are becoming more expensive compared to Japanese. So this will encourage British consumers to buy Japanese imports instead. And if you look at the Japanese exchange rate in the 70s, 80s, 90s, the yen appreciated in value because it had a lower inflation rate, whereas the pound tended to fall in value because of slightly higher inflation rate compared to others. So in the very long term, a strong exchange rate is usually a reflection of a strong economy, a growing economy and low inflation, high productivity growth, and more competitive than its competitors. In the short term, many things can affect exchange rates, such as geopolitical events. So if you look at, the Russian ruble, that when there's been an invasion or annexation, there was a sharp fall in the value of a ruble because of sanctions and also because of lack of confidence. People don't want to invest if they're uncertain about the political economic future of the economy. Also, exchange rates can change because of speculation. Suppose that we anticipate US interest rates are going to rise next year much more than elsewhere in the world. Then this anticipation of higher interest rates will cause investors to buy dollars now because they want to buy the dollar because they know it will probably go up when interest rates in America increase. So in the short term, speculation can play quite an important role in the day-to-day movements in the exchange rate. Now, what's the importance of exchange rates? Well, if there's a sharp depreciation in the value, there's a decrease in the value, then it has both benefits and costs to the economy. The people who generally will be happy from a depreciation is exporters, because when the pound falls in value, UK goods become more competitive and they tend to be able to export more. But the downside of a depreciation is that it tends to put up inflation, and it can cause inflation for a few reasons. Firstly, when there's a depreciation of exchange rate, import prices will go up. You have to spend more to get the same imported goods, so we get some imported inflation. Secondly, there will tend to be a boost to aggregate demand because we import less but export more. So that is more money coming into the economy, more demand. So we get some demand pull inflation. Also, if there's a depreciation, there's an argument that exporters may become less efficient. They've got less motivation to cut costs because they can rely on the easy fix of a depreciation to increase competitiveness. So it's argued that depreciation in the long term can encourage lack of productivity growth, and you become more uncompetitive over time. So depreciation tends to cause inflation and lower living standards because consumers are having to spend more on imported goods, but exporters will be happy. Now, the effect of a depreciation does depend on a few factors. Firstly, it depends upon the state of the economy. So if you have a depressed economy in a recession, high unemployment, then in that case, a depreciation can actually be a good thing because at that time, inflation is not really a problem, and you do need that boost of demand that a depreciation gives. However, if your economy is at full capacity and there's already some inflation, then a depreciation in the exchange rate will cause upward pressure on inflation, and there's limited growth capacity because the economy is close to full capacity. The exchange rate also affects other things such as the balance of payments. If there's a depreciation, then we tend to get an increase in quantity of exports and fall in quantity of imports. And this tends to improve the current account deficit because we're exporting more. But it does depend upon elasticity of demand. If demand is quite elastic, then we will definitely get an increase in the current improvement in the current account. But if demand is very inelastic, then that fall in the price of exports may only have a limited effect in increasing demand. So just to summarize, the main thing about exchange rates is that they're determined by supply and demand factors. If a currency becomes more in demand, the value will go up. This will make imports cheaper and exports more expensive.